Hi, welcome. It is March 14th, 1 p.m. We just got the closing bell, and hopefully you were able to catch or watch the pre-market video that I pre-recorded last night for this morning. In that video, we talked about how the PPI report was unlikely to get us very directional, but it would give us plenty of volatility. In order to get directional, it had to get above a certain level or below a certain level. And otherwise, it's just a very volatile day, and we wouldn't read too much into it. So let's take a look at what the market reaction was to that PPI report, because it did guide the trading throughout the day, but did it break those significant levels, or did we stay in a muted range? So let's go ahead and take a look at our intraday charts. And we can see the S&P 500 after that report, we started to trade downwards. And then as we got into the morning session, we did drift into the open, lower into the open, right at a significant level, one that we drew right here around 516 and 3/4. And then it dropped down from there down to 514 or 515 around this area. And we chopped over there through most of the day until we got more volatility. And then finally we traded down to 512 and back up to 515 at the close. So it stayed within our ranges. So we told ourselves that we weren't going to get too worried. We weren't going to get bearish unless we fell below this 512, which was also the EMA 8 on the daily chart. But we wouldn't get really bearish, or we wouldn't get really concerned until we got below this 508 level, and we didn't get there. So this EMA 8 held today, and we got a nice rebound in the last half hour up towards the 515 level. So let's take a look at the daily chart just to get some perspective. Because if we just look at this, we might get bearish. We might go, oh, that's not looking so great. And whatever positions that we had to the long side would have suffered today. But is it an abnormal move, or is it absorbed within the acceptable range of the holding period for our investments? So let's take a look at that daily chart. Take a look at SPY. You know what? Let's start at the beginning. I want to get back into the habit of looking from the very broad picture. So let's look at DXY. DXY was chopping sideways. I gave some guidance on, depending on how the PPI report came out, would it go up or would it go down? And it came up right into this trend line. So chances are this trend line is going to hold, and we're going to keep on moving downwards. If we have a weaker dollar, that is a stronger stock market. So if this does reject off of this trend line, then we can expect at least support from the currency markets for a continued movement upwards. So that's an argument for bouncing off of whatever level that we are right now. We will see, because PPI report isn't the only thing that is affecting the bond markets and the currency markets, but at least this particular movement takes away, or it was this entire move to that trend line and gives us a strong possibility of bouncing off of it, which is a good sign for the markets overall. If I look at TLT, TLT kept on coming down. It gapped down and traded lower throughout the day. This is almost a completely solid bar. So we opened at the highs and closed pretty much right at the lows, just 10 cents away from the lows. So that's a very strong movement. We are kind of close to this purple line right here, this horizontal. But given how the PPI report came out, this does have potential to break below that line and then test this downward sloping channel. So a baby position in a TLT short or TLT put would be a pretty good investment right now. At the very least, you could catch it down to this horizontal line and then decide if you wanted to hang on to it or if you just wanted to take your profits at that point in time. When we look at the S&P 500, I was sharing that 512 level, and we bounced off of it. So even though we have this red bar, you can see that we traded, at least at the open, it was pretty flat. We traded a little below this EMA 8, but we traded right back up. So what is this EMA? This is 513.23, but yesterday it was 512.74. So today's EMA 8 was higher, which is why it looks like we came down below the EMA 8, whereas in the daily chart we were referencing yesterday's EMA 8 because we didn't know what that value was going to be today. So we did cross below that EMA 8, but this is a nice bounce off of it. So this is not anything to be concerned about. Yes, we got a red bar. Yes, it looks like it, at least throughout the day, was going to be significant, but it wasn't. It's just down 0.2%. There's nothing to get too fearful about. So let's see what happened on the VIX. See if the market makers are concerned at all. Yeah, so it spiked up, but after we bounced in the last half hour, looks like we traded back down and we are elevated a little, but not that much, which is appropriate because we did come down today overall, but just not that much. So this is not a huge or unexpected move for the VIX. When you look at the SPY, this is still a very healthy trend. We are still above the EMA 8. We are kind of still in the range of this box, so we'll see what happens. But we did bounce off of that EMA 8, so we could remain above this box. And this uptrend is still intact, and we should still be positioned to the upside. So if we have any calls or if we have any longs inside of our portfolios, you took a little bit of a hit today if they weren't specifically hedged. And it's okay. This is within normal movement, unless you look at the individual stock level and it had an outsized move and it did not follow or correlate to the market today, then you would actually look at the individual stock and see. But from the overall market perspective, this is still an uptrend. You should still be net long on your positions. We are not at a high risk place, especially since we did bounce off of the EMA 8. So to have a individually hedged position or an entire portfolio hedged position, with the exception of maybe a black swan event type of hedge, is not really necessary at this point in time. So any type of fear we might have felt from today, we can just say, hey, this gives me a better perspective and there's no real reason for me to get all that negative, at least when I look at the S&P 500. It may be a different story if we look at the other indices. So let's go ahead and look at our QQQ. QQQ, similar story. We came in and touched and went below that EMA 20, but bounced right off of it. We are in between the EMA 8 and EMA 20 and trading within a box or a sideways range. Here it is. No. I won't bother, but this is fine. This is continuing to chop sideways. We're still in above the trend line right here and the EMA 20. So we're just treating this as consolidation, sideways movement. Maybe in the next couple of sessions, we will test that uptrend line. And if we consolidate straight through that uptrend line, then we'll start to consider maybe being slightly bearish on the QQQ. For now, there's no reason to be, although, as I said in the recorded video last night, there is an increased risk that this is forming a top, and the move after this consolidation is a little more likely to be to the downside than to the upside at this point. But we're not there yet. That's at least a couple sessions away. So that's most likely next week's business and not anything that we have to worry too much about this week unless we get really directional tomorrow for some reason. If we look at DIA, and when I say for some reason, it's because there's not a lot to stimulate the market. Tomorrow we've got industrial production. Yeah, it's an okay report. After the PPI, it's not going to be that significant. Consumer sentiment, you can see that they labeled it as a green rather than a red star. Normally, consumer sentiment is pretty important, but after the CPI, after the PPI, is just going to be a little less important than it normally is. Dow Jones chopped sideways. It initially started higher, and then it came down and challenged its EMA 20, but ended up above its EMA 8. So this is what we were talking about, where it's might just keep crossing the EMA 8 and the EMA 20 for a while until that MA 50 catches up. And then we'll see if that stimulates a break. We could break before then, but if we do, to the downside, the MA 50 is right there. It's not that far away. So we wouldn't expect a free fall or a downtrend to develop from that. If we then subsequently broke the MA 50, that would be a different story. But for now, it's in a pretty safe position. We're really just consolidating sideways. So let's take a look at the PPI report. Why was there this large intraday movement, but we did not actually switch to a bearish sentiment overall in the markets, even though if we only looked at today, it might have felt that way. So if we go to this report, PPI, okay, month on month and year on year, we increased significantly more than both the consensus and the prior. So month on month, it was only 0.3%, and then we doubled it to 0.6%, and the consensus was that it wasn't going to change at all. So we completely blew through expectations on the month to month, and on the year to year, we went up almost double, again, 0.9% to 1.6%. And then the consensus was only a move upwards, only 0.3%, and we moved up 0.7%. So more than doubled what the consensus was. That's why we have this larger reaction than we had to the CPI report. The CPI report did come in and show us higher inflation than expected, but it was only 0.1% higher than what the consensus was. So yes, we had higher than expected inflation, but it just wasn't that much more than what people had agreed that it might be. If we look at the ex-food and energy numbers, year on year, it stayed the same, but month on month, it actually came down. That's why the government likes to use ex-food and energy, but it's really not a good reflection of the actual picture of what's happening inside of our markets and inside of our economies. So the markets are reacting far more to just the pure print rather than to the ex-food and energy trades and services. So we are actually taking everything into account because it does impact the consumer and the producer. The food and energy absolutely affects producers. Energy, every producer consumes energy. So every consumer consumes food and energy. It is a big part of their expenses. So to discount them and ignore them is a little bit silly when you're actually trying to examine the financial markets. The government, I don't know. I've never been in the government. I don't know if it's silly for them to not consider it or not. But if we're talking about the economy and the financial markets, it's silly not to consider them. So this is a significant increase in inflation to the producer side that it foreshadows potential and likely inflation for the consumer, because for the most part, producers are able to pass along higher prices to the consumer. And there's only a few instances where they can't, but for the most part, we can transfer over to the consumer. So that foreshadows higher inflation in the future. Let's see how it affected our chances of a rate cut. If I go to March, we're still at 1%. We're probably going to stay at 1% until we actually get the announcement next week. May, we're down to 4.1%. It was 10% yesterday. June, we were down to about 63%. We were at 70% a couple of days ago. And then yesterday we were at 66%. So we came down a tiny bit, not that much, not as much as we might have thought from a move from the TLT. So this is not only pricing in the change in probability of a rate cut. This is also pure like current interest rate and also currencies. The dollar. This was affected by the DXY today. That's a big move in the DXY. Okay, so overall, our markets are still strong. There's no reason to believe that they're to suddenly become bearish. There's no reason to believe that the uptrend is over, although we do have a lot of reasons to believe that it might be over soon, especially if we're looking at a 2 to 3 month time frame. But in the next week, at least on the S&P, doesn't look too likely. QQQ in the next week will probably challenge it, so we'll find out. And then on the Dow Jones, we might challenge it, but really we're going to this period where we're spanning the EMA 8 and EMA 20 like we did the last week, and then we drifted up, but yeah, we could try to just cross those two moving averages again. We're probably in the Dow Jones not going to see a lot of movement until at least the MA50 comes up and joins the party over here. So overall, in my viewpoint, there's no real change to the markets after that PPI report. I did not expect the PPI report to make a real change in the markets, given the muted reaction to the CPI and the opposite reaction to the CPI. But PPI was a much larger than expected move. And even then, it didn't send us into bearish mode. It didn't cross our 512 level. It didn't come down to our 508 level. Certainly didn't approach our 505 level. So it's actually, this market is still very strong. If a PPI print can't dampen the enthusiasm within the market, then we're just not there yet. There is still strength inside of this market. The S&P in particular, more so than the other indices, still has the potential of making another all-time high before coming down and testing that uptrend line again. And then we'll see. Maybe not. We're really not expecting necessarily an imminent breakdown through this uptrend. We are expecting it with higher probability in 2 to 3 months, but not necessarily next week. We're not really expecting it next week, maybe the week after. So we'll see. We'll see how next week plays out. Tomorrow has the potential. We did bounce off of this EMA 8 today. So it wouldn't be surprising if we made a new high tomorrow in the S&P 500, especially since we crossed and bounced off of that EMA 8. The same with the QQQ. We crossed and bounced off of the EMA 20 and landed not above the EMA 8, if I remember. The the Dow Jones did land above the EMA 8, but on the QQQ, we are a little below that EMA 8, but it shouldn't be too much of a challenge to cross above it if we do get bullish going into the weekend. So overall, still optimistic about this current uptrend. We're not expecting to break it tomorrow. QQQ could challenge it again tomorrow because we are very close in terms of our lows and this trend line. We are consolidating closer and closer to this trend line. Challenge, I don't expect it to break. If anything, we might just sit on top of it or sit a little bit below it. I don't expect a free fall because, again, there's no stimulus. If anything, large institutions might go into protection mode for the weekend, but that doesn't mean markets come down. It just means that they're hedging themselves. So barring any weird news over the weekend or any weird news tomorrow that might affect the entire markets, that would have to be pretty big news. There's nothing on the economic calendar. Most of our major earnings reports are completely over. This earnings season is pretty much over. There's not a lot going on. I might as well peek at this fear and greed index. Yeah, we're still up here in greed. So there's no reason to be pessimistic at this particular moment in time. Next week might be different. 2 weeks from now, maybe even more different. But for now, hang on to your longs. If you are truly concerned, then just go ahead and do a specific hedge against each one of your positions. Or you can make your life easier and just hedge the entire portfolio. But for now, it just doesn't feel like it's absolutely necessary at this point in time. Okay. So hopefully we have a good perspective. We took a step back out of the intraday movement, and the daily perspective shows us nothing really to worry about. If I look on the weekly, I might as well take a quick look. You can see that after that doji bar last week, our bar day is positive, and the close right now is above the close of last week. We are still moving higher inside of this trend on a weekly basis. QQQ, we're sitting right on that trend line, but at least we are at or slightly above the close of last week. And on the Dow Jones, we are above the close of last week. The SPY in particular still looks very, very, very strong. And what I didn't look at was the small cap stocks. Let's look at IWM on a weekly basis. That is weakening. It came into this pink range, back into the pink range. So it looks like we're collecting a false breakout right here. So touched, broke through, came right back in, broke through again, and now we've come back in. So we're going to wait for this to come back up and challenge this level again. And if it breaks through, we're going to wait for that pullback and bounce and confirmation before we get excited about the IWM or small cap stocks. So this is just telling us, hey, this is not the super clear bull market yet. Yes, we are in an uptrend, but we're not in a strong bull market. We really need the IWM to catch up to the S&P 500 before we get optimistic about a strong bull market. So this is supporting that we might have a pullback or a correction sometime in the next 2 to 3 months. It might have been a different story if this had continued to move upwards or make a new local high or 3-month high right here, but we didn't. So this is fitting the story of wait and see. In the next couple of weeks or next 2 to 3 months, we might have a more major pullback and consolidation. Then everything can realign and defragment itself in terms of sectors, in terms of indices. And then when we move up from there, then it would be a higher probability of us going into a actual strong bull market. And that is probably, timing wise, an actual real strong bull market, if it does form, is most likely after presidential elections, since this is a election year for the United States. And now we've had an entire quarter, almost an entire quarter, a couple weeks away from entire quarter. So if this strong bull market doesn't develop by now, then it would not have enough time to run up before elections. So most likely we might continue, we might still have uptrends going up to elections, but we're not going to expect it to be a super strong bull market until after elections. And the way things are looking, it's unlikely that this current uptrend is going to last all the way until elections. That would last all the way until November. That would be a little extreme. So a pullback or a consolidation is definitely appropriate before we get to elections, and we might run upwards into elections, or we might just retouch the highs, the all-time highs that we've been making so far. So if we get a correction or a pullback, and then we retrace back and then get roughly even to where we are currently before the elections, and then we have a market reaction to the elections, either to the upside or downside, that would be a pretty normal and pretty expected pattern. So that consolidation and pullback, we are still expecting it in a couple months. Within a couple months, that would bring us to May or June, right into the summer. And then we could move downwards for the summer and then either consolidate or bounce into the elections and then pick a direction after elections. So from a longer term perspective, that's what the market currently looks like. So nothing to get too excited about. We just had mostly a sideways day with a bearish tint to it. Uptrend is still intact. We're still going to point our portfolios to the upside. There's no specific need for a hedge at the moment, but especially in the QQQ, that could get challenged within the next week. So I think that's it. I think we have a pretty clear picture of what's going on. The PPI gave us a lot of information and gave us a lot of clarity. So for now, it just looks like another maybe possibly another week of an uptrend, at least in the S&P 500. Okay, guys, hopefully you got good clarity. I will see you tomorrow morning in the pre-market session. Tomorrow afternoon, I'm not going to do a live after-market session. And after the last couple of weeks, we've been skipping a live after-market session, and we've just been combining the Friday after-market with the weekly market review, and that works pretty well because there's a lot of overlap in what we see in a Friday close and when we look at the overall view of the entire week. So I think going forward, we'll just keep that. We won't have live Friday sessions, and we'll keep the weekly market review and just cover whatever we were going to say in the Friday after market session at the same time. So have a wonderful night, and I will see you tomorrow morning.